Hi, Assalamualaikum and have a good day to Dr. Nur Saada and all fellow viewers. So today we are from group 3. We are going to present you guys about section 39 1A until section 39 1E is about non-allowable expenses. So our group is formed by first, Nurul Hiza binti Syarul Nizam. Second, Nur Hidayah binti Zainan. Third, Nur Syafiqah binti Azman. And four, Siti Nazira binti Muhammad Nawi. So, as you can see in the slide, non-allowable expenses is required in order to get adjusted business income. So, you can see net profit before tax plus with business income is not recorded yet, and plus with non-allowable expenses, plus with approved donation, less with other incomes that have been recorded, less with double deduction expenses, so you get adjusted business income. I want to clear up the section covered by this group is only section 39(1) subsection A, domestic and private expenses, section 39(1) subsection B, expenditure not wholly incurred in the production, section 39(1) subsection C, capital withdrawn or any sums employed as capital, section 39(1) subsection D, contribution to the non-approved schemes, and section 39(1) subsection E, qualifying mining, prospecting and agriculture expenditure. So, I will pass the presentation to the first presenter who will present about section 39(1) subsection A, domestic and private expenses, Nurul Syafiqah.
Hello, my name is Nur Syafiqah binti Azman and I am the first presenter. Okay, let's now learn about Section 39(1). Section 39(1) of the Income Tax of 1967 establishes certain general principles and defines which expenditure are not deductible in calculating adjusted income. The expressly disallowed expenses refer to both business and non-business sources. What is under Section 39(1)(A)? There are domestic and private expenses. For domestic or private expenses, they are not deductible in arriving at the adjusted income. Now, what are really the meaning of domestic and private expenses? Domestic and private expenses are the expenditure that are related to traders, private residents, wages of domestic servant, and private telephone bills. For example, the cost of hiring domestic servant to help in housekeeping while the other one is away at work is not deductible. The dicta do not mean that all travelling expenses from the house to the place of work is a private and domestic. There are several exceptions in this rule. The exception of the rule that can be low is the cost of travels between two places of work, one in the city and another one is about 40 km away, was allowed even though one of the places of work happened to be the place of the resident. The taxpayer was a public accountant and a registered tax agent. She practiced her profession at both places. In allowing the claim, the board has said, a taxpayer is not to be denied a deduction for travelling expenses between two places of business merely because she resides at one of those places. In another case, Federal Commission of Taxation versus Ball City, a professional footballer claimed the cost of travel between his home and place of matches. The commissioner will prepare to allow some part of the cost from home to outstation matches, but not the cost of travel from the resident to the home games. If it can be established that the travelling is an integral part of taxpayer employment or business, then such cost of travelling may be considered for a deduction.
Assalamualaikum warahmatullahi wabarakatuh and greetings to everyone, especially to my lecturer, Dr. Nur Saada binti Jamaluddin and my fellow students. My name is Nuriza binti Sharizam and I'm going to continue to present for this topic. In section 39(1), state that subject to any express provision of this act in ascertaining the adjusted income of any person from any source for a year of assessment, no deduction from the gross income from that source of that period shall be allowed in respect of any expenditure is not wholly incurred in the production, which is included in section 39(1)(b). The following specific expenses outlined in section 39(1)(b) based on ITA 1969 are not deductible in arriving at the adjusted income from its source. Such expenses falling in this category include charitable subscription, donation to cultural and political parties, and lastly, salaries and wages paid for the family members. First, charitable subscription. A deduction is allowed for a cash donation to approved institution made in the basis period for a year of assessment. A deduction is limited to 10% of the aggregate income of the company for a year of assessment. Next, a donation to cultural and political parties. Business cannot claim political donations, political contributions, or payment on the tax return. Bear in mind, charitable donations such as giving money to any approved organization are generally tax deductible, while any donation made to political organizations or political candidates are not, because these donations include in non-charitable donation deductions. For example, the company did a donation about 10,000 ringgit to one political party. This money in order to help for the political campaign. In this situation, 10,000 ringgit not deductible in their tax return. Lastly, salaries and wages paid to family members of the trade or businessmen which are in excess of the commercial rate is not deductible. For example, a wholesale hardware dealer who hired his daughter, who just dropped out of school before her Malaysian secondary school examination, as a receptionist in the shop and pays her about 5,000 ringgit per month may not be allowed the full deduction of the salary paid. Thank you. That's all from me. Next, I will pass to one of my member of the group to continue to present this topic.
My name is Siti Nazira binti Muhammad Nawi D2021010924. Today, I will explain about capital withdrawn and any sum employed as capital under Section 39(1)(c). Let's begin. Under Section 39(1)(c), even if a sum is solely and exclusively expended for the purpose of producing income, it will not qualify for deduction if it is a capital expenditure. Thus, expenditure incurs in the improvement of an existing asset, for example, from the way of an alteration or addition to a factory buildings, or in addition to planes and machinery, will be treated as capital and it will not qualify for a deduction because
it under capital expenditure. The next case is if the interest paid on a loan taken to buy machinery or even hire purchase, interest paid on such an acquisition will qualify for a revenue deduction and it will not be treated as a part of the cost of the plant and machinery. However, the interest paid on the machinery is before the commencement of the business or before the machinery is brought into use be treated as a part of the cost of the machinery. The next case is how about if a partner in a partnership retires? In this case, when a partner in a partnership retires, any capital withdrawn by him is not deductible. And in an introduction of capital into the business is also not a chargeable income, so there is no deduction. The next is example for this section. For example number 3, Encik Ahmad as the manager of the shoes factory pay the interest charge on a loan made to buy a new machine worth 10,000 for the need to produce shoes. Apart from that, Encik Ahmad also made improvement to the existing asset in the factory, namely adding a factory building. So, which one is qualified for deduction? So, for the answer, in this case, the interest paid that charge on the loan made for buy machine is qualified for deduction because in this case is it under a revenue deduction, but the improvement that made to the existing asset is in the factory, namely adding a factory building is not qualified for deduction because it is a capital expenditure. So we know that only interest pay that have a deduction. Next, I will pass to the next presenter.
Hello, have a good day to Dr. Nur Saada and fellow viewers. So I will continue the presentation into next section, which is in section 39.1 subsection D, contribution to a non-approved schemes. So, any amount in respect of any payment to any pension, provident, savings, widow, and orphans or other similar funds or society which is not approved scheme are considered as contribution to a non-approved schemes. So, what is exactly approved schemes? Approved schemes refer to the schemes which is approved by Director General, where no approval is granted. Any contribution will not be deductible, notwithstanding that it may be revenue in nature. Okay, we move to the next slide, which is example situation of contribution to a non-approved scheme. So the first one is unapproved pension or provident fund scheme or society. So this is refer to the employee's contributions made to an unapproved pension or provident fund from which payment is made to the employee before or after the cessation of his employment. So as you know that pension is a payment due to the retirement, and categories that we receive the pension is due ill health when they have compulsory at retirement, or on death, which is the pension we given to the widower, child, or dependable. So from the situation number 2, which is an employer makes contribution to an unapproved pension fund in respect of an employee for the period 1st January 2004 to 30 March 2012 amounting to RM4,000. So that means the employee have made contribution to unapproved pension amounting 4,000. So the 4,000 is the non-allowable expenses under unapproved pension, section 39 1 subsection D. So in the term of pension, the pension will be taxable when the person receive unapproved retirement scheme, which means non-government pension scheme required to prior approval from LHDNM for tax exemption on pension, receiving more than one pension and retired before the compulsory age retirement. So from the next situation, when they have the unapproved pension received by widowers and child, when they have on debts, so unapproved pension fund to widow and orphan, this refer where they have contribution any written law relating to widower and orphans unapproved pension on that. So it will be placed under non-allowable expenses. And lastly is unapproved contribution. So what is mean by contribution is employee provident funds contribution, a contribution in kind donation to a project of national interest that unapproved by the minister is considered as non-allowable expenses because the employee has do a contribution to a project that not approved by the minister. Okay, we move to the next section, which is section 39 1 subsection E. In this section, we talk about qualifying mining, prospecting and agriculture expenditure. Okay, this section prohibits the deduction of certain expenditure that fall under the various schedules to avoid the possibility of a double deduction of certain expenditure. In fact, special treatment are accorded to this expenditure, which usually consists a heavy capital expenditure on land, building, or plant and machinery in the relevant schedules. So any expenditure incurred in relation to a business being expenditure, which is first qualifying mining expenditure for the purposes of Schedule 2, second qualifying plant or building expenditure, qualifying agriculture expenditure, or qualifying forest expenditure for the purposes of Schedule 3. And lastly, qualifying prospecting expenditure for the purposes of Schedule 4. So, and which for this paragraph would be deductible in ascertaining the adjusted income from the business. So, this section is serve as a preventive section, preventing double claim of deduction of the same expenses from the gross income, since the capital income can either be given capital allowance under Schedule 3 or specific deduction against aggregate income. Thus, if they were also allowed as deduction, it would represent a double claim of deduction. So, section 39(1) subsection E clarifies that even if the expenditure is deductible, but for this paragraph, deductible is allowed. Okay, I will continue to the explanation of qualifying mining expenditure under Schedule 2, paragraph 1. So, qualifying mining expenditure is expenditure incurred in connection with the working of a mine or in preparation for the working of a mine. So, we can see in the situation of A, on the acquisition of the mine or rights in over the mine. B, on searching for, on discovering and testing, or on winning access to deposit of minerals. C, on the construction of any works or buildings which, when the mine ceases to be work are likely to be little or no value to any person except in connection with the working of another mine or on development, general administration or management before the production of mineral begins or during any period where minerals are not produced. So, I will give the example cases which is in DGIR versus TM Sdn Bhd on 1974. The Federal Court held that the acquisition of land which contained mine deposit was not qualifying mining expenditure at it was not expenditure incurred in connection with or in preparation for the working of the mine. It was a mere acquisition of mining land. So, the example of mining expenditure is cost of site, testing deposits, or prospecting, roads, labours, and the development on mining. Next, we will move to the next schedule, which is Schedule 3, about qualifying plant or building expenditure, qualifying agriculture expenditure, or qualifying forest expenditure. So, for the qualifying agriculture expenditure is capital expenditure incurred by a person under paragraph 7, Schedule 3, when the situation of A. The clearing and preparation of land for the purposes of agriculture. B. The planting but not replanting of crops on land cleared for planting. And C. The construction on a farm of a road or bridge. Lastly, D. The construction on a farm of a building used for the purposes of the business on that person, which consists wholly or partly of the working of the farm, or the construction on that farm of building which is provided by that person for the welfare of the person, or as living accommodation for a person employed in connection with the working of that farm, and which if the farm ceases to be worked, it's likely to be of little or no value to any person except in connection with the working of another farm. So, example of Schedule 3, which is qualifying agriculture expenditure, is preparing of land, new planting, construction of road or bridge on farm, construction on farm of building either used in business or living accommodation for employee. The definition of agriculture means any form of cultivation of crops, animal, farming, aquaculture, inland fishing, and any other agricultural or pastoral pursuit. Further, in paragraph 7, subsection 2 of Schedule 3, agriculture include reforestation of timber. Okay, last but not least, the lastly schedule, which is Schedule 4, qualifying prospecting expenditure. So, qualifying prospecting expenditure is defined as expenditure wholly and exclusively incurred in searching for, discovering, or winning access to deposits of minerals in an eligible area, or in testing any such deposits. It does not include expenditure incurred on the acquisition of the site of the sources of the deposits, B. the sites of any works which are likely to be a little or no value to the sources is no longer worked, C. the rights in or over such site, or rights in or over the deposit. So, what is meant by eligible area? Eligible area is any particular area in Malaysia which does not consist of or include an area with respect to which there is or has been enforced at any time before the end of the basis year for the relevant year any lease, license or certificate in which mean other than a prospecting license or certificate, grant or issued under any written law regulating mining and granted, issued or assigned to the prospector before the end of the basis year.
In conclusion, expenses are very important to the business because it helps business keeping up with their cash flow. It also helps small and big business owners plan for the future with more clarity and confidence without making any mistakes. Capital inflow and outflow are daily processes in any business. Large sums of money are spent as well as earned, and generating a profit is the ultimate goal of a company. But the business owner need to know which expenses is allowable deduction, special deduction, double deduction, and not allowable deduction in order to reduce the tax of the employment income. This is why it is very important to know the statutory income tax of the business, and company can manage to increase or decrease the expenses of the company in order to fix the employment income tax. That is all the presentation from the group 3. We only present about section 391A until E. The next section 391F until R will be presented by the next group. Thank you from us.